School Radio, 91.3 KDKR Decatur, Dallas, Fort Worth, and 91.3 KYJC Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, what you need to know about risk. Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Listen, if you got a question for me, I want to invite you to go to the website at www.prudentmoney.com. Once you get to the website, there is a link at the top of the web page. Just click through and you'll get a Q&A. You can send me your question, and I'll get your question answered. It's not a great way to get information. However, if you need more help than just a couple of emails, you're always welcome to sign up on my calendar for a time spot, and we can spend 15, 20 minutes or so on the phone and get a little bit more detailed on the answer. So whatever I need to do to help you out, we'll be glad to do so. Just go to the website at www.prudentmoney.com. Well, today is the one day each month that pretty important, at least the markets are still thinking about it being important. I'll give you my take on it here in a second. But the inflation numbers come, they announce those every, I guess, second, let's see, today is, I guess the second Thursday maybe, or something like that. Anyway, they do it one time a month, and they announce what the last 12 months of inflation, if it's gone up, gone down, surprised people today by going down a little bit. But really, that is not a whole lot of surprise if you consider some things about what's really going on with inflation. I personally believe that the whole idea and notion of inflation is over with. I believe that the costs that you see today, minus a few categories of costs, could still come down some. But I think, for instance, I think that the prices we're going to be paying, that we've been paying for eating out is a good example. It's one we always kind of pick on. I think those are set. I can't imagine a day where restaurants get together and they go, we've been charging way too much. No, I think everything is pretty much etched into stone. And these are the price levels that we're going to have to deal with. So whether it goes up or down really comes, now if it starts going up, that's a little bit more of an issue, because that gives businesses like restaurants the excuse to continue to raise up prices. But I don't think that we're going to really see that. It could fluctuate a little bit here and there. But I think that unless we get a new president that really ramps up inflation, and that's some of what Donald ex-President Trump, could be soon President Trump, is some of the things he wants to do would potentially raise inflation and raise costs. So what the market is looking at, as we know, is will the Federal Reserve Board cut interest rates? And of course, we've debated that and talked about that. I think that if they're going to do, which would be a huge mistake, which is the reason, and they know that, which is the reason they put off thus far making any bets with interest rates, that I lost my train of thought. But anyway, it's getting to, I know what I was going to say, that they're getting too close to, a senior moment there, sorry. They were getting too close to the elections to be tinkering with interest rates. So I think if they're going to do it, which once again, it's not a good idea, but if they were going to do it, they would do it probably at the September meeting. So that's kind of what I said. It wouldn't surprise me if they lowered interest rates a little bit just to kind of get the economy going. But that was the other thing too. One other report that they look at every Thursday is the unemployment benefits and the claims on unemployment benefits. That really gives us an idea on a weekly basis in real time what's going on with unemployment. Of course, that would be is a very key driver to the Fed lowering interest rates, because that could, if we started to see unemployment rise, those weekly claims rise, and then the the number they report once a month go up, then you're looking at a situation where we could have economic problems, and if we have economic problems, then they're definitely going to be lowering rates. This is one of the things that, rates right now are between 5 and 5.25%. If they were to lower rates back down to almost zero, which is really where they would have to be for the mortgage rates to go back down as low as they were, that would signal that we'd probably be in a big economic crisis if they had to lower that much. So, bear that in mind. One of the things they look at with the inflation rates is they take the number and they exclude volatile food and energy costs. I don't know why I think that's funny, because those are like the two big ones. So they call that the core consumer price index, and that increased by 0.1% and 3.3% from a year ago. And it's hard to believe, back about this time, but it was in June of 2022, and the CPI was up around 9%. One of the things that affected the inflation numbers, which I has really been a factor that I think is under this kept inflation rates a lot lower, is a 3.8% slide in gasoline prices, held back some of those increases on both food prices and shelter. So that is it for this month. We'll see what the next month is. But once again, I think it's kind of a moot point with inflation. I just don't think you're going to see it move that much. Now, it would be an interesting situation if we saw inflation really start to go up again. But don't think that's going to happen. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. I do appreciate it. Listen, have you taken the risk survey tool yet? The risk assessment tool, let me say it that way. That is a way to measure your risk level and let you know exactly, compared to what the risk you're taking today, if you are in the right category. I think that's very, very important. One of the things we're going to talk about today is the actual risk level that resides in the stock market, and maybe not the one that you think is there. And ties all the way back to everything that happened with the financial crisis. Well, like I said, we'll talk about that here in a minute. But if you haven't done so, go take the risk assessment tool. It takes maybe 5 minutes to take. I designed it myself. Once you fill it out, that we'll be alerted that there's a new one, and we'll fill out a personalized analysis for you, along with about a 2 or 3 page explanation of how this works. Like I said, I think it's a very good tool to help you and to help you understand exactly what risk level you should be at. It comes at 4 different levels. The top one is a growth level. I don't go as high as aggressive growth. I very rarely see that. But a growth level, which is trying to make what the market's making. Of course, if you try to make what the market's making, you can lose what the market is capable of losing. The next one down is a moderate, which most people fall into that category. Then the next one is conservative. Then you have, after the conservative level, you've got what I call safe money. That's what I want to talk a little bit about with you today is investments that have guaranteed returns. I noticed just right before I went on the radio that most of your fixed annuities work like a CD. They have a guaranteed return, rate of return or growth rate that goes for a certain amount locked in for a certain amount of time, and the risk level. That's the safe money guaranteed return level. But what we're starting to see is those guaranteed returns coming down a little bit. The highest I saw them go was one company was at 6%, and they're coming down. But we've always talked about this. You've got to be very careful with annuities. Of course, annuities can have a bad reputation. I did one that was deservedly so. Not so much for the fixed annuities, but for other different kinds of annuities. They're a little bit more complicated, and that stems from annuities that were developed in the 90s and maybe lasted for 5 or 6 years. A lot of lawsuits, a lot of complaints, and they were called equity index annuities. They got rid of them, but that reputation for being a bad product has stuck. So what I find is people either really like them or they really don't trust them, don't like them. It goes both ways. So regardless, I would say this is that if you look at the majority, I hate to say this, but I do believe this, the majority of annuities on the marketplace are probably not that great and have a lot of got-yous in them. You got to be really careful. But there are some great programs that you can get involved in. And we'll talk about that in a little bit. This is Bob Brooks. We're up against a break. Stick around. I'll be right back. Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
This week we continue our study of the parables of Jesus on Truth for Life. We'll consider the tight grip idols can have on our life, the dangers of empty, legalistic religion. We'll find out what Jesus taught about spiritual fruitfulness, faith, and forgiveness. Join us this week on Truth for Life with Alistair Begg.
Weekdays at 5:30 a.m. here on 91.3 KDKR.
Enjoy KDKR wherever you go on all your devices with the free Live 365 app. Just download Live 365 from your app store and search for KDKR Bible School Radio.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Got a question for me? You know where to go, prudentmoney.com. Send it in. We'll get you taken care of. That's, all at the website, prudentmoney.com. Talk a little bit about annuities, what you need to be careful with, because they do fit they do have a good place as far as asset allocation goes, with the interest rates that they pay out, but you have to be careful with the what I would call very aggressive marketing. Hear a lot of this on the radio and a lot on commercials that air, and basically what you're hearing is an investment that grows 7% a year. Guaranteed, and you get an upfront bonus of 15%. Now, think about that with me for a second. If I told you that there was an investment that you could average 7% a year and you could get 15% up front, I just wonder how many people would get in touch with me and definitely want to know more information. Well, that's not really what happens with an annuity. When they talk about the 7% a year, they're talking about not growth of the annuity. So in other words, it's not an investment that you're going to get this 7% locked in, guaranteed year in, year out, and then at one point in time you can take all the money out, the 7% return, everything, plus the 15% bonus, and it's all yours. That's unfortunately what I think a lot of people do think is going to happen, and it's the fault of how they're advertised and how they're marketed. I know one company is very aggressive on FM radio, and he talks about the 7% and the upfront bonus and all that. He slides in there though income value, but still I think people hear the 7% and they kind of get locked into that. But that is all tied to an income feature and not a growth feature of annuities. But the bottom line is you just need to be careful with what you're doing. They can provide a great alternative to bonds, for instance. At least, like I said, I don't know how much the rates are going to go down, but from current rates, they do make a good replacement. And that's the problem with bonds right now. The bond markets have not been real good. Interest rates are still pretty low. You still have a lot of risk built into the bond market, and I personally still think that's a place where we're going to see problems. But this does, though, the fixed annuity and maybe the fixed index annuity, depending on which one you use, could offer a very, very good replacement for it. Not a recommendation, just something that I've come across. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. I was thinking about risk in the stock market as today we saw the market take a little bit of a loss. Hadn't seen that in a while. It mostly has gone up, and it starts to get that feeling that, can't miss, kind of almost a guaranteed going to get a return, and that there's just not much risk in the market. And that could be the thing that is furthest from the truth. And I want to go back to the days prior to the financial crisis, the great financial crisis, the Great Recession that occurred between 2007 and 2009. That was 2007 represented the top of the stock market, and the March 2009 represented the bottom of the drop of the stock market. And if you recall, in fact, I'll tell you a story. I'll never forget this. It was October of 2008. This was before, I believe it was before Lehman Brothers. Probably haven't heard that in a while. Lehman Brothers at the time was the second or largest investment firm in the world. And I was watching my stock market screens and watching what the market was doing on a day on what's called an intraday, which is real time, what's happening at the moment. And it just started to drop really fast. I hadn't seen anything like this really ever. And it was dropping and dropping and dropping. Then all of a sudden it kind of paused and came back up and then kind of settled in a little bit. But what was happening at that point, because the market knows what's going on before, is kind of in drops in anticipation of something happening. Literally the financial system was cratering. And of course, as we know, we got the first big taste of the government stepping in, too big to fail. Of course, they let Lehman Brothers go under, which was a huge mistake. But this is where the government stepped in and started bailing out companies. And the Federal Reserve Board started coming to the rescue of the economy and pumping money into the economy. And this is when you really started to see government manipulation of the markets. So one of the things that you've got to realize is that the market prior to all that happening acted pretty normally from the standpoint of risk. If you saw a lot of, there's indicators that would suggest how much risk is in the market. If you saw that build, typically that was a precursor to the market coming down and declining because of the risk. Today you can see those risk levels. You see them today, and yet the market continues to go up. And I think what has ended up happening, one of the things I talked about on the what I talked about on the radio back then was that you have to take and segment the market into pre-financial crisis, where things act a little bit more normal than the financial crisis, which is what was chaos. And then following that going forward, you had the journey to the new normal. So you had just a lot of government assistance, a lot of government takeover, bailouts, and then you had the Federal Reserve getting on board and printing a lot of money, and they started printing this. This was all behind the scenes, of course. And so what has ended up happening, this is my own personal belief, just by watching things, because don't you find it strange, granted the market went through what I call the COVID crash, where for about 40 to 45 days it dove, I think 30-something%, then all of a sudden rebounded straight up like a rocket ship, went up and had put in an incredible month. The entire time that employment was going way out of control, businesses were shutting down, the economy was down, I think 15% at one point. And if you would have told me, let's say I didn't hear any news reports, didn't know anything that was going on, if you told me that we had all these things that we had going on with the pandemic, I would tell you, if you told me to predict what was happening with the stock market, I would tell you the market had dropped worse than the Great Depression. But no, it was taking off because the Fed saved the day. The government saved the day. And so what I think has happened is that the markets now view risk a lot differently. They don't view it as they don't respect risk. That's why I think things have gotten so out of balance. And we saw a decline in 2022, but it was a 10-month, 28% snoozer that rebounded back up, and that was no bear market. That was a correction. So I think that's why you got to be really in tune with what your risk level is, and be really in tune with understanding the risk that goes along with stocks. So just something that I was writing a client letter today and thinking about that, and it dawned on me, this is the new normal, and risk is not really viewed upon as severe as I think that it should be. When I say severe, I mean the problems that you could have with the 401k turning into the 401 half K, whatever people used to call it. So a different time that we live in, and if you look back to the other example that I used was, you realize if 4 banks went under last year, one of those banks was the 5th largest bank in the country, went under. The market barely even budged. I remember a day back in the 90s when the market would have cratered given those statistics, but the government stepped in, shored up the banking system, provided all the capital that was needed, got J.P. Morgan to take over the one big one bank, and all the rest was history. You had FDIC really in a sense, covering everything, not just $250 per account. So the times that we do live in make for interesting radio, I guess. This is Bob Brooks. If you got a question for me, please go to the website at prudentmoney.com and send it in, because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.